Good morning, colleagues. My name is Sonke Dandala from the Stakeholder Management and Communications Department at the GEPF. Firstly, I'd like to welcome you all to this webinar on the two-component retirement system that we will be taking you through. So that's the first thing, is just to say welcome to everyone that's joined. And we hope that more people will be joining. We're currently sitting on just over 800 people that have joined the webinar, and we are sure that number will be growing. Just a quick overview of what will be happening. We are using a Teams platform called Town Hall. The reason for the platform is that it allows up to 10,000 attendees to join the webinar at a time. However, what it does then is that you would have noticed that it has automatically muted your mic, meaning that you will not be able to speak back to the presenter as a normal Teams meeting, simply because of the numbers, and that might be difficult to manage in terms of 10,000 people all trying to speak. However, if you look on your screen, there is a Q&A section where you can type in your questions and your queries. And what we will do post the presentation, we will go through all of those questions one by one, and hopefully trying not to repeat any questions that have been asked more than once. So that's how it will go. So please listen attentively. If you have a question, type it in the Q&A section, and the questions will then be answered at the end of the session. The presenter for today is Mr. Brian Karidza, who is the head of Actuarial and Benefits Administration at the GEPF. So the issues relating to the two-component retirement system lie within his area of responsibility. So he's our resident expert at the GEPF, and he will be taking you through the presentation. The presentation will take roughly 1 hour and 20 minutes. After the presentation, we will then go into the Q&A section to respond to all the questions that have been posed by the attendees. Mr. Karidza will then respond to all those questions. We are reviewing the questions, so if you do type something and it doesn't come through, it might be because it's a question that someone else has already asked, and then we won't publish it for viewing, but we will publish as many of the questions that come through that are relevant as possible. Without any further ado, I'd like to introduce to you Mr. Brian Karidza, who will then take you through the presentation of the two-component retirement system. Thank you very much.
Thank you, Sonke. Just a quick audio check. Can you hear me clearly?
It's Brian, yeah, we can hear you clearly. Thank you.
Okay. Thank you once again, and welcome to all the attendees. My name is Brian, and I'm heading up the Actuarial and Benefits Administration function at the GEPF. I've been given the difficult task of taking you through the changes of the two-component system and their implications for you as a GEPF member. So unless you've been living under a rock, I'm pretty sure everyone is aware of the impending changes that will be coming from 1 September 2024. What is not clear, or what is not immediately clear, is how exactly it will work for the GEPF. So we've set up this webinar to cover some of the gaps and to give you an opportunity to engage with us and get a better understanding of how this two-component system will work for the GEPF. So in the legislation, it's referred to as the two-component system, but we will refer to it as the two-pot system, as that's the more familiar term that goes around. So we'll start off with just the background, but we won't delve into we won't spend too much time there, because I'm pretty sure we're all aware of the reasons why this system has been brought up. We'll then get into the details of the proposals of the two-pot system and what it entails for the GEPF specifically. Then we'll look at some of the changes and implications and benefits, and we'll also touch on the claims process and our general advice and guidance that we give to members. And as Sonke said, we'll then open up the floor for questions on the Q&A. So why do we have this discussion around the two-pot system? Where did it all start? So if we scroll back a few years, the world was in crisis. We had the COVID-19 pandemic, which led to a slowdown in economic activity. Some companies had to shut down. They had to cut down on expenditure. Some lost their jobs. There were even salary cuts. So most households were facing financial pressure. And then due to this financial pressure, there were increasing calls for members to have access to their pension fund savings to alleviate them from this pressure. And then the challenge at the time was that there was no flexibility within the pension funds system, which would allow members to have access to their retirement savings. So the current regime presents opposing challenges. First of all, I'm pretty sure you're aware with the widely published statistics of that there are not enough people who save up for retirement. The widely reported figure is that only 6% have enough savings for comfortable retirement. So in one hand, it's pointing for a need for greater preservation, whilst at the same time, there's indication that a lot of members face financial pressures throughout their working lifetime. So there's a need for some flexibility to access pension fund savings. Now, the challenge is that the current system does not give that flexibility. So what tends to happen is that when members resign, they cash in on the pension benefits, or some even resign intentionally with the sole intention of cashing in on the pension benefits. So the policymakers then went back to the drawing board and decided to come up with a new system that would try find the right balance to solve both problems. So the new system that came out would be one that would promote preservation of your benefits, but at the same time allowing you some form of flexibility in terms of what you could access from your pension fund savings. This is what has led to this discussion and the reforms around the two-pot system. We have looked at the background. Now let's start looking at what the two-pot system entails. We'll start off with a high level or overview of the two-pot system, then we'll start engaging into the exact details of the different components and different pots. So in a nutshell, if I was given a minute to describe what two-pot is, it is a system that will allow members to access a portion of their retirement savings without them needing to leave their work or leave the fund. And this is intended to assist them with planning for unforeseen financial emergencies. But importantly, the system also allows for compulsory preservation of the bulk of your pension savings. And this amount that is then saved has less flexibility than what you had before. So in a nutshell, the two-pot system is introducing two changes. You're going to have some form of access to your pension fund savings without having to exit or the fund or leave your employment. But at the same time, there's an element of compulsory preservation, which will help ensure that when you reach retirement age, you retire with sufficient savings to have a comfortable retirement. So that is the overview of the two-pot system. Now let's start getting into a bit more detail. So from 1 September 2024, this is what is going to happen going forward. Any amounts that members save or accrue towards their retirement savings will be split into two different pots. There's the savings pot and the retirement pot. And you'll note that there's some differentiation between the pots, but we'll come to that later in the slides that are coming after this. At the same time, you have benefits that you've already earned before 1 September 2024. You are part of the GEPF, you've been contributing, you've been earning benefits. These benefits are not going to be lost or they're not going to be changed. They're going to be recognized in a different pot. And this pot will be subject to the same rules that are there currently and will be subject to the same tax treatment that is there currently. But we'll get into the deeper details of the different pots in the coming slides. Another important concept of two-pot system is the concept of seeding. Seeding is the once-off transfer that will occur on day one being 1 September 2024. This is the mechanism that will allow a portion of your vested pot to be transferred into your savings pot. But there are certain restrictions which we will touch on in more detail when we start looking at the different pots. Importantly, we want our members to understand that the two-pot system is being automatically enrolled and includes the GEPF. So no member will have the option to opt out. From 1 September 2024, all active members of the GEPF will be part of the two-pot system. For the GEPF, we operate as a defined benefit fund. So unlike a defined contribution fund, the benefits that are due to you are mainly dependent on your salary and on your years of service. So when we split the benefits that will go to the different pots, that will be done with reference to your pensionable service. And we also want to reassure our members that the allocations to the different pots is on a notional basis. This does not imply that there'll be a physical separation of those assets, and as such, there will be no separate investment strategy for the different components. So we've looked at two-pot at a high level. But the changes are so vast, it's not enough to just look at it at a high level. Let's dig deeper. Let's start exploring what the different components and pots are. Let's start understanding how they operate. So I should have led with this when I begin the presentation. So this presentation is going to feel like a roller coaster. There are certain sections you'll be happy about and they'll get you very excited. There are certain sections that will probably get you worried and you won't be as excited. But we'll go through this journey together. So let's start with the boring parts. And I've just included a nice infographic there just to break the ice and get us into the mood of learning about two-pot. So let us pay particular attention to this vested pot. This pot is peculiar in that it has a lid, but it's not fully closed, and it is intentional. Part of the reason why the lid is not fully closed is that there is some form of access you have to this pot, but it's not as easily accessible as some of the pots. And yes, I've got some interesting dialogue there. What is our vested pot telling us? This guy is saying that you're all used to me, I'm old-fashioned, so you do not find me exciting. And that is true, because what you've been receiving as GPF benefits, that's what you're used to. That is your vested pot. So it's based on your current rules, based on current taxation processes and regime. So you're used to this guy. But there's an extra thing there he's saying, and I sort of feel for him. He's the pot that we have ghosted. He feels like a third wheel on a date. I mean, we call it a two-pot system, but he's part of the system. He's the third pot that's not talked about. So let's give him the necessary attention that he deserves and dig into a bit more detail. So what exactly is this vested pot? So remember, you are currently part of the GEPF. You have benefits that you have earned and you have benefits that you continue earning. So all the benefits that you will have earned up until 31 August 2024, those are going to be under the current tax regime. They're going to be under the current rules in terms of how the benefits grow and how the benefits are earned. They're going to be under the current rules in terms of how you access the benefits. So this vested pot is all the benefits that you have earned or that you will have earned up until 31 August 2024. As such, so if you go back to an earlier slide, I say that as a DB fund, all the benefits that we allocate to your pots are referenced, are determined with reference to your pensionable service. So your vested pot will be referenced to your service up until 31 August 2024. And as previously mentioned, the benefits that are recognized in this pot are subject to the current regime in terms of taxation and in terms of the rules of accessibility and the rules in how the benefits are determined. You'll be able to access this pot on all forms of exit. So whether you resign, whether you retire, whether you unfortunately pass on, at any point that you exit the fund, you are entitled to your vested pot balances as before. And you're taxed on the same basis as currently. So that depends on the type of exit. Obviously, if you are withdrawing, whether it's a resignation and so on, you're subject to the SARS withdrawal tax rates. And if you are retiring, you're taxed at the retirement tax rates. Now, an important thing that I want to highlight and that I want our members to be aware of, and this is one of the things that members have shown concern around. I have noted that the benefits that are allocated to this vested pot are based on your service up until 31 August 2024. So what does this mean? This means that your service is going to be fixed for that point, because when you look a year later, your service up until 31 August 2024 will be the same. But this does not mean that the balance in the vested pot will stay the same. Your balance in your savings pot will actually change each month, and strictly speaking, each day. So it will change with reference to with changes in your salary, if there are any changes, and it also changes with age, because you're then subject to a different actuarial factor. So your vested pot balance will increase each month, and the value and it won't stay stagnant. But let's look at an example. Don't take my word for it. Let's just look at a simplistic example to help us understand what we mean by that. Let's consider a 40-year-old member, and let's assume that they've got 10 years of service on 1 September 2024. So what this implies is that they've got 10 years of vested service. Let's also assume that this person is earning a salary, as a final salary of 300,000 on 1 September 2024. So on the system, or if they request for their benefit statement, the balance that will be reflected in the vested pot is an amount of 610,800. And this is based on the 10 years of vested service. It's based on that 300,000 of the final salary and the relevant actuarial factor for a 40-year-old, which is that 0.203 that we've outlined there. Now let's look at the same member 1 year later. They are now 41 years old. Let's also assume that their salaries have increased in such a way that their final salary is now 315,000. Remember, we say the vested pot is going to be based on fixed service up until 31 August 2024. And that fixed service is based from the period in which you became part of the GEPF up until 31 August 2024. In our case, even though it's 1 year later, his vested service is still what? 10 years, because he had 10 years on 1 September 2024. And it doesn't matter that it's now a year later. We are not increasing the vested service. It remains at 10 years. Now let's look at what balance would be reflected on the system. It's now higher. We are seeing an amount of 643,576. It's based on the 10 years as before, but it's now based on a higher salary, and it's based on a different actuarial factor, which is higher than the one a year before. So despite having the same period of service, because we say the vested service will not change, the vested pot will show a different balance due to changes in salary and the change or the change in actuarial factors as you get older. So this is just to provide comfort that your vested pot will always will not stay stagnant. We've spoken about the vested pot balance. There's an important concept that we need to look at. We've said that the benefits that you'll have earned up until 31 August 2024 are going to be saved in this vested pot. And then you're going to have these two new pots going forward from 1 September 2024. But on 1 September 2024, it means you're starting from a 0 point or a 0 basis in those new pots. So the policymakers decided that, okay, what if we allowed for a mechanism such that a member can have a non-zero starting balance in their savings pot? And then they said, okay, let's allow for this concept of seed capital. So seed capital, in simple terms, is the amount that you'll be able to transfer from your vested pot into your savings pot on day one. Day one being what? Our implementation date, 1 September 2024. So seeding capital refers to that portion of benefits that will be accessible to members immediately on 1 September 2024. This seed capital is transferred from your vested pot to your savings pot on 1 September 2024. But there are restrictions on what can be transferred. What are those restrictions? The policymakers and the law stipulates that what you can transfer is 10% of what you have in your vested pot, but subject to a maximum of 30,000. What does that mean in practical terms? It means if 10% of your vested pot is greater than 30,000, you can only transfer or seed 30,000. If 10% of your vested pot is less than 30,000, you can transfer or seed the full 10%. In such a case, it does not mean that you transfer 30,000, but you transfer the full 10%, whatever that amount gets to. Importantly, seeding is just a transfer of your benefits from one pot to the other. As such, no money is leaving the fund, and there is no taxation of that transfer. Then another important thing to understand is that this seeding is going to be automatic on 1 September 2024. It's going to be applied to all active members, and it is not optional. So you do not have the option of keeping all your amounts in the vested pot. The seeding will be done automatically for all members. This is all a lot to take, so let's look at an example to help illustrate the seeding capital and the limits and the impact of the restrictions. So let's say we've got a member whose accrued benefits is at 1 September 500,000. So in other words, we're saying they've got a vested pot of 500,000. What does the Act say? The Act says what you can seed or what you can transfer is 10% of your vested pot balance, but subject to a maximum of 30,000. So in this case, 10% of 500,000 is 50,000. But this 50,000 exceeds the limit that has been put in the legislation. It exceeds the 30,000. So even though your 10% is something higher than 30,000, you cannot transfer more than 30,000 to your savings pot. So for this member, even though they were entitled to a 50,000 transfer, what they're allowed to transfer within the law is 30,000. Let's look at the table below to understand what that impact is. So just before seeding, this person had 500,000 in their vested pot, and there was nothing in the other two pots. So their total benefit is what? 500,000. Now we've noted that they can seed 30,000. So we're going to take 30,000 from that vested pot and transfer it into the savings pot. What is the new position? He now has 470,000 in the vested pot because we've taken away 30,000. The 20,000 which he couldn't take, which he couldn't transfer, still stays in that vested pot. So he's got 470,000 in the vested pot. His savings pot has now been topped up. We took 30,000 from the vested pot and put it into the savings pot. So now he has a balance of 30,000 in the savings pot. But look at the total benefit. It's still 500,000. And this just further signifies that no money has left the fund or no money has left the member record. We've just changed the allocation between the different pots. Let us look at a different example. Suppose that this member had 100,000 in their vested pot on 1 September instead. 10% of that 100,000 is what? 10,000. 10,000 falls within the 30,000 limit. So such a member will be able to transfer the full 10,000 to the savings pot. So the seed capital for this member is the 10,000. They cannot transfer 30,000 because 30,000 then violates the 10% limit. If he transferred 30,000, it would have meant that he has seeded 30% of his vested pot. That violates the 10% limit that is in the legislation. So such a member will seed the full 10,000 amount. Again, let's look at the position before and after seeding. Before seeding happened, he had 100,000 and it was all in the vested pot. He has transferred 10,000 into the savings pot. So he has seeded that 10,000 and now he's left with 90,000 in the vested pot and he has 10,000 on the savings pot. But the total benefit is still the 100,000 which they had. So this just shows how seeding works and also shows how the limits and restrictions would be applied. So we have touched on this boring pot. Let's move on to a more exciting pot. So we've got this savings pot and let's see what he's saying to us. He says he's the new guy in town. And let's be honest, he's the pot that we're all excited about. And why are we excited about this guy? As you can see from that pot, he doesn't have a lid. This is symbolic in that it's signifying that you can access the benefits that are in this pot. The pot is, however, smaller than the other pots, signifying that it will be a smaller portion of your retirement savings. But that doesn't stop us from getting excited about him. Let's get into a bit more detail. So from 1 September 2024, all the benefits that you're going to earn going forward from that date, benefits that are based on 1/3 of your pensionable service from 1 September 2024 will be allocated to your savings pot. So if you think about a year, it means that for those 12 months, 1/3, which is equals to 4 months. So 4 months worth of benefits will be allocated to your savings pot. On day one, before you have seeded, you're going to start with a zero balance. But like we spoke about, there'll be a once-off transfer that will be allowed from your vested pot to your savings pot. And that will then allow you to have a non-zero balance on day one. And that is the seed capital that we spoke about earlier on. And we reiterated that that transfer is not taxable and is an intra-fund transfer, and hence it's not seen as a withdrawal. Then going forward, benefits based on 1/3 of your future of your pensionable service from 1 September 2024 will be allocated to that pot, and each time we'll recalculate the balance that is recognized in that pot. So why is this pot exciting? What I've said is not really exciting. So let's get to the exciting bits. Why are we excited about this pot? Why are we looking forward to this pot? So the savings pot is introducing a new mechanism which has not existed before. For the first time in our retirement funding system, you'll be allowed to access benefits within your pension fund savings without having to resign, or without having to leave your job, without having to leave the fund. So members will now be able to access the balances in this pot before retirement. And more importantly, you will not have to resign. You will not have to provide any proof of financial distress. You will not have to leave the fund. However, there are some restrictions. So what are these access restrictions? First of all, the amount that you can withdraw from your savings pot has to be at least 2,000 Rand. So you cannot come to the GEPF and say, I want to withdraw 500 Rand. You cannot come to the GEPF and say, I want to withdraw 1,500. There is a minimum requirement in terms of the amount that can be withdrawn, and that is 2,000 Rand. Unless you've got special circumstances, which we'll touch on later. So what does this also mean? It means for you to be able to access the savings pot, you need to have at least 2,000 Rand as a balance. So if you have less than 2,000 Rand, I'm sorry, you cannot come forward to the fund and put in a request for this saving withdrawal benefit. So this the withdrawals that you can take from the savings pot without having to resign. They are defined in the Act as a savings withdrawal benefit. So one of the restrictions is that for you to be able to make this savings withdrawal benefit, you need to have at least a minimum balance of 2,000 Rand. The common question then is there a restriction on how much I can take out? So the answer is yes and no. So just like in a bank account where there's no overdraft, the restriction is you can withdraw up to the balance that you have available. So yes, the same restriction applies in the savings pot. You'll be able to withdraw up to the maximum amount that is available in your savings pot. This does not mean that you have to that each time that you withdraw, you have to take out that maximum amount. But we're just saying that if you're to come forward with a withdrawal request, you can withdraw anything from 2,000 Rand up until the maximum balance that you have in that savings pot. And a common misconception that I hopefully will be able to address and correct here is that a lot of members out there think that, okay, so this means that each year I can only access up to 30,000 Rand. No, there is no such restriction. The 30,000 that we spoke of, that's a once off that is going to be applied on 1 September 2024 and refers to a limit on how much can be seeded from your vested pot to your savings pot. Going forward from your savings pot, the only limit in terms of the maximum that you can take out is what you have in that savings pot. If you have 20,000 in your savings pot, you can take up to that 20,000. If you have 50,000, you can take up to that 50,000. It does not mean that you will be restricted to take only up to 30,000 in a year. The restriction is that whatever is available is the maximum that you can take out. There are other restrictions as well. We've spoken about the restrictions relating to the amounts that you can access. But those are not the only restrictions. There's a restriction in terms of how often you can access your savings pot. So the law is saying that you can only access your savings pot as a withdrawal once in a tax year. So what is a tax year? Our tax year in South Africa runs from 1 March each year up until the end of February in the subsequent year. So this means if you made a withdrawal on 1 September 2024, the earliest point at which you could come back to the fund and request for withdrawal would be for a savings pot withdrawal would be 1 March 2025. Now, let's look at some of the unattractive parts of the savings pot. The Revenue Laws Amendment Act has defined the savings pot withdrawals as part of your gross income. What does this mean? This means whatever you take out from your savings pot will be added onto the gross income that is taxable. And this is taxed at your marginal pay-as-you-earn rate, or in other words, it's taxed according to your income tax bracket. So whatever you take out from your savings pot will be taxed according to your marginal rates. It's going to be added to your other taxable income and it will be taxed on that basis. And once you've put in a claim for a savings pot withdrawal, the GEPF will receive a tax directive from SARS and it will be required to retain this tax portion and pay it directly to SARS. So when you make a request for an amount, let's say you request for 20,000, what will go into your bank account is not 20,000. It will be 20,000 less any tax that is due to SARS. So it's important for our members to understand that any amount paid out from the savings pot will be taxed at your marginal rates, except at retirement. Now, a common question is, I don't even know what these marginal rates are. I've got your back. Here's a table with your marginal rates. So currently your salary is taxed according to these brackets. And whatever you take out will result in your gross income increasing. And then depending on which bracket you end up, that is how you'll be taxed. Let's also, another common question is then what are these, you spoke of withdrawal tax rates. What are they? So these are the tax rates that are applicable currently on resignations and if you leave the fund before retirement. And as you can see, they're different rates and actually a bit lower than your marginal rates. So this is one of the unattractive aspects of accessing your money early, in that instead of being taxed at your resignation rates from your savings pot, it will be taxed at your marginal rates. A common question and misconception, especially when we discussing DB funds like the GEPF, is I understand that money is going to be allocated to different pots, but how exactly is it going to grow? Unfortunately, we are all wired to think in a defined contribution arrangement where you put money aside as like in an account, and then it grows with interest, and what you get is that money plus the interest that it has earned. However, we are operating in a defined benefit world. What you're entitled to as a benefit is actually not directly linked to your contributions and the interest they grow to. What you earn as a benefit is specified in the rules of the fund and depends on your service and salary, as well as your age, which affect the actuarial factors. So let's look at how your savings pot would typically progress for a random member. Let's consider a 40-year-old on 1 September 2024, and let's walk with him throughout 1 September 2024 to the end of February 2025. Let's assume that this member has a final salary of 300,000 and that it grows in January 2025 to 305,000. We'll also look at his benefits before and after seeding, and we'll look at the growth in the benefits at each point in time. So let's start off with the first column on 1 September 2024 before seeding. He has got, remember our definition of the savings pot. We said your benefits will be based on 1/3 of your pensionable service from 1 September 2024 going forward. But on 1 September 2024, you've got no service in your savings pot. You've not served a day after 1 September 2024. So you'd start off at 0. Then we said there's a special concession that is allowed for, which is the seed capital. So for this member, we've assumed that he had an amount in the vested pot which allowed him to seed the full 30,000. And when he seeded that 30,000, it means we are now crediting his pot with some form of service. And for this example, we've just assumed it's about around 0.49 years. Now, 1 month later, what is happening? He still has the 0.49 years, which is seeded. So we're assuming that he's not made a withdrawal. 1 month after, so at the end of September, he has now served what? A full month. But we've said what is going to be credited as service in that pot is 1/3 of that 1 month. So at the beginning, after seeding, he had 0.49 years, and it's grown to what? 0.52. He's now 1 month older, so his actuarial factor has changed slightly. It's increased from what it was before. So his balance is no longer 30,000 as before. It's increased to 31,700. Same thing happens 2 months after, at the end of October. He served 2 months from 1 September 2024. We're allocating 1/3 of those 2 months, and it's being added to what he had as the seed service, the 0.49. And as you can see, the balance keeps growing each month up until we get to the end of February 2025, where his balance is now what? 40,929. So though this member started off with 30,000 after seeding, when we came to the end of the tax year, he actually had a higher amount. It was now 40,921. And it means that if this person decides to withdraw on 28 February 2025, he can withdraw anything from 2,000 to that 40,900. Okay, so we've looked at the progression. Now let's look at what you can take out. So we said you can take out anything from 2,000 up until the maximum balance in your savings pot. But this amount that you take out, it's not free. Yes, it is your money. It is what you're entitled to. But whatever you take out from your savings pot, it will not only reduce the balance in your savings pot, but it also means it's reducing the service that is recognized in that savings pot. So there is no free lunch. Any amounts that you withdraw from your savings pot will result in a reduction of your savings service. Let's look back at our member that we looked at just now. Let's see the impact of making a withdrawal. So I'm just going to scroll one slide back. So I just want us to have these numbers in mind. In this example, they did not withdraw anything from their savings pot. So when they reached 28 February 2025, they would have a balance of 40,921. Now let's look at a case where he actually makes a withdrawal. So his starting point is the same. Started off at 0, he seeded 30,000. Each month it was growing, December got a bit hectic, he spent too much money, and now he has got January, he's thinking about January disease and all the fees and other things he has to pay for. So he decides to withdraw he decides to empty his savings pot at the end of December or at the beginning of January. So on 31 December 2024, his savings pot balance was what? 36,829. His service that was recognized there was 0.6 years. He has emptied that account. So at the beginning of January, he's starting off at 0 years of service because he's taken out everything. So in other words, he's lost those 0.6 years of service in the savings pot. Now, let's look at the end of January. We're crediting him with what? 1/3 of service for that 1 month that he has worked being January 2025. Remember, he has lost all service that he had up until 31 December 2024, or he has lost all service in the savings pot that he had up until December 2024 because he took out all the money. And then we got to the end of January. It's almost like you're counting the clock again. He's served 1 month. He gets allocated 1/3 of that 1 month worth of service, and the balance that he has there is 1,727. At the end of February, he's worked another month. He's allocated an extra 1/3 of that 1 month as service in the savings pot. His balance is now what? 3,455. Now compare to the balance he had when he did not withdraw. At the end of February, he had what? 41,000 or so in his savings pot. But he withdrew in December, and it meant and he emptied the account. So it meant he was starting from scratch. And then now at the end of February, he has a lower balance. So what that example is showing is just the impact of making a savings withdrawal benefit. It reduces the amount that you have in your savings pot, and it also reduces the service that is recognized in that savings pot. And then what is the secondary implication of that? It means that eventually when you get to retirement, you're going to have a lower gratuity. So all the withdrawals that you make in your savings pot are reducing what you get as a lump sum at retirement. But it's not going to affect your what you get as a pension. So we've looked at your savings pot progression. We've looked at the impact of withdrawals on your savings pot. Let's look at some of the deductions that will be allowed from that savings pot. So now we're getting into some more depressing parts. So SARS has confirmed that if you have a tax debt, so if you owe SARS tax, and if you go ahead and make a savings withdrawal benefit, SARS has the right to withdraw or withhold their tax and the tax debt before they pay you your savings pot. So what does this mean? It means if you owe SARS, in addition to paying tax on the amount that you're taking out, they can then deduct the full amount of the tax debt that you're owing them. So in other words, you end up getting less than what you've requested to withdraw. Another deduction that is allowed for is deductions from outstanding maintenance orders. If you make a savings withdrawal benefit and you have outstanding maintenance orders, those maintenance orders are first right, and they'll be deducted from your savings withdrawal benefit before you eventually get paid. Let's look at a simplistic example. So let's say we have a member who has 50,000 in his savings pot. And let's say he comes forward to the GPF and says, I want to withdraw 40,000 from the savings pot. Let's also assume that this person falls within the 26% tax bracket. So when he sends this application, the fund has to get a tax directive from SARS. And then SARS then, in this example, we're assuming that this member owes debt. So SARS notifies the fund that, no, this person actually has a debt of 10,000 because there's 10,000 worth of unpaid taxes. Let's look at what this person would eventually get paid. So remember, this person has requested for what? 40,000 from the savings pot. So the first deduction will be the tax due on that 40,000. And we're assuming that he's going to be taxed at 26%. So he has to pay 10,400 worth of tax. But in addition to that, we've said for this member, SARS has identified that he actually owes tax worth of 10,000. So in addition to the 10,400 tax that is due on the withdrawal, they're going to deduct the 10,000 from the tax debt. So this person has requested 40,000, but will only get paid 19,600 in their bank account due to the tax on that 40,000 and due to earlier tax debts which he did not settle. So SARS is going to have first right on this money. And God forbid, if this person owes maintenance, will even get lower than this amount because it will be deducted from there as well. So unfortunately, I've got more depressing news. Just because the savings pot is accessible and available does not mean that you'll always be able to get paid from it. There are certain circumstances which could lead to the savings pot not being payable to you. So let's look at some of those circumstances. So if the employer has obtained a judgment against the member for fraud, theft, dishonesty, or misconduct, and if it is deemed that there's not sufficient money left in the fund to pay the employer, then you will not be able to make a savings withdrawal benefit. That request will be blocked. If the fund is notified that the member is in the process of getting a divorce, the non-member spouse must consent to the member claiming a savings withdrawal benefit. Where the fund receives a maintenance order in respect of the member, and if it is viewed that there will not be sufficient funds left in the fund to pay the maintenance after this withdrawal benefit, that request will be blocked. And where the fund receives a notification that a maintenance order is pending against a member, and there's an interdict that is sent to the fund to prohibit the payment, that will mean that such a member will not be able to put in a request for, or will not be able to successfully request for a savings withdrawal benefit. So that concludes the discussion on savings, on the savings pot. It started off exciting, but we had to finish off on a depressing note because we have to discuss the restrictions around it and the situations in which you would not be able to put forward a claim. Now let's move on to that other pot that we are all not excited about, the retirement pot. Let's see what this retirement pot is saying to us. Saying that you hate me now, but you love me when you're older. And the reason why we're saying that, and if you look at the pot, this pot is bigger than the savings pot. It's got a closed lid. So it's bigger than the savings pot because it's signifying that a higher proportion of your retirement benefits are allocated to it. It is closed, indicating that there's less access to this pot. Actually, it's very restricted. You'll be barely able to access this pot up until you reach your retirement. So even though we hate this concept now, it is the pot that is going to ensure that you reach your retirement age with sufficient savings to have a comfortable retirement. And hence why it's reminding us that we'll love this pot when we're older. So when we spoke about the savings pot, we said that 1/3 of your pensionable service will be allocated to it. The remainder, which is the 2/3 of your pensionable service from 1 September 2024, that will be allocated to your retirement pot. This retirement pot will be heavily restricted. It can only be accessed at retirement or on earlier death. No withdrawals will be allowed before retirement, except in special cases of like a divorce. More importantly, and I think I forgot to mention this on the savings pot. So when you reach retirement, your savings pot is going to pay you a lump sum. It's not going to pay you a pension. And then similarly, when you reach retirement, the balances in your retirement pot will pay a pension. They will not pay you a lump sum. The only way for you to get paid your retirement pot as a lump sum is if the annuity portion of your vested pot together with the balance in the retirement pot is less than 165,000. This is the only time where you'll be paid your retirement pot as a lump sum. Otherwise, your retirement pot is going to pay you a regular pension that is payable for the rest of your life. If a member emigrates, they will not be able to get paid immediately from the retirement pot. They'll have to prove that they've stopped being a tax resident for 3 years, and only after then will they be able to get paid from the retirement pot as a cash benefit. The current provisions relating to the payment of beneficiaries when you pass on, that will stay the same. So if you pass on, your retirement pot can be distributed to your dependents as cash lump sums. Importantly, the payouts from your retirement pot will be taxed at the SARS retirement tax table rates. And like I said before, this pot, we hate it now, but we'll love it as we grow older, because it is the one that is forcing preservation and allowing us to ensure that we retire with sufficient pension when we reach our retirement age. So we outlined your marginal tax rates. We showed the withdrawal tax table rates. Now we're showing you the retirement tax table rates. So payments from your retirement pot will be taxed according to this to this retirement tax table rate. So we've discussed the different pots. Now let us look at some of the changes that will take place going forward, and let's just get into a bit more detail around that. So we'll start off with your service period. So currently, when you look at your benefit statement, you see a single service period, and that is sufficient for our needs right now because all your benefits are based on that single service period. That single service period is based on the period from which you became part of the GEPF, but it's subject to deductions on divorce and can be added if you purchased service. Now, going forward, it will no longer be practical or ideal to have a single service period because your benefits will now be determined according to the different pots. So from 1 September 2024, your total pensionable service will be split into 3 different service periods. You're going to have your vested service, which will be based on the period from the date in which you joined the fund up until 31 August 2024. You will have your savings service period, which will be based on 1/3 of your service from 1 September 2024 going forward. You'll have retirement savings that will be based on your service based on 2/3 of your service from 1 September to 2024 going forward. And as always, any reductions on service periods on divorce or additions on purchase of service will apply as before, But what will change is that for future purchases or future deductions, they'll be in the 1/3, 2/3 split between the savings and the retirement service. And your total service will then be the sum of all three service components. So let's look at an example just to further illustrate what we mean by that. So let's consider a member who joined the fund on 1 September 2014, and let's assume that they've not purchased service and that they've not been divorced. So on 1 September 2024, it's 10 years later, this person has 10 years of pensionable service and has been a GPF member for 10 years. So what is the system going to record? As vested service, we're going to see 10 years based from the period from 1 September 2014 to 31 August 2024. On the savings service, there'll be 0 years because he has not yet served a day after 1 September 2024. And similarly, there'll be 0 years of service for retirement service. Now let's look at this same member 1 year later. So we're now looking at him on 1 September 2025. Let's assume that he has not withdrawn anything from the savings pot. He has not purchased any service and he has not had any divorce. So on 1 September 2025, this person has 11 years of pensionable service and has been a member of the GPF for 11 years. What is the system going to record? Your vested service is still 10 years because we are restricting it to your service period up until 31 August 2024. Your savings service is going to be 4 months because it's 1/3 of that year, or 0.33 years. And your retirement service will be 8 months because we've allocated 2/3 of that year to retirement service. Now let's look at that member again. But now let's assume that on 31 August 2025, they took out their whole savings pot. So in other words, on 1 September 2025, they no longer have savings service. So what is going to be recorded on the system? This member has been a GPF member for 11 years, but their pensionable service is now 10 years and 8 months. This means that despite you being a member for 11 years, when we calculate your benefits are now going to be based on 10 years and 8 months. The system will have 10 years of vested service as before, but it will now have 0 years of service in the under savings service. Because even though you served the full year and you had 4 months, you withdrew 4 months worth of benefits. So you're left with 0 years of service. Your retirement service stays the same, it's the 8 months. So in total, you've got 10 years and 8 months of pensionable service, which is used to determine your benefits, but you were a GPF member for 11 years. So this just shows that your pensionable service is not the same as your period of membership. And whenever you make a withdrawal from the fund, it is going to reduce your pensionable service. So the higher, so remember that your benefits are determined directly by your pensionable service. So the higher your pensionable service, the higher the benefit entitlement. And if you lose service due to you making savings withdrawal benefits, it means when you retire, you're going to retire with a lower overall benefit. The common question is, can I still purchase services before? So yes, you'll still be able to purchase service, but it's going to be treated slightly differently going forward. Service that you've already purchased, that is allocated to your vested pot. But service that you purchase from 1 September 2024 going forward will now be restricted to the 1/3, 2/3 split. So this means that any service that you purchase going forward from 1 September 2024, 1/3 of that service will be allocated to your savings pot and 2/3 to your retirement pot. So what this means then is that there's no mechanism for you to replace what you've lost in your savings pot in isolation. If you purchase any service, to be allocated to your savings pot and your retirement pot. You'll not be able to say, I just want it to go only to your savings pot. The other change will relate to your benefit statements, and I'm just isolated what we expect the benefit statement to look like for resignations. So, like we said, currently you see one service period But in your future benefit statements, you're going to see the 3 service periods reflected. We're going to show the service that you've lost due to savings withdrawals, and you're going to show any purchases of service or any amounts you lost due to divorce. And then in terms of actuarial interest, it will be split between your 3 components. So you will have your vested pot, actuarial service, your savings pot, and retirement pot, and so on. And then when it comes to resignations, we'll be showing you what you can access as cash, because this is limited. And we'll also be showing you what will be accessed if you were to transfer to another fund. So we've looked at some of the changes in terms of principles. Let's now look at how these changes relate to the different benefits payable when you exit. So the actuarial interest represents your share of your benefits in the GEPF. Going forward, you will not be showing you a single actuarial interest value because that will no longer be practical. Now you're going to have actuarial interest in your vested pot, and actuarial interest in your savings pot, and an actuarial interest in your retirement pot. And they'll be based on the respective service components. So each balance that will be reflected in your pots will be the actuarial interest based on that particular service. So your vested pot will be the actuarial interest calculated on vested service, and so on for the other pots. And then the total of those balances will be your total actuarial interest in the fund. Now let's look at some of the big changes. Your resignation benefits are going to be significantly affected by your 2-pot system. So currently when you resign, you get to access your full actuarial interest as a lump sum benefit. And then you also have the option of transferring it to another fund. So in 2-pot terms, currently when you resign, you get your vested pot as a cash lump sum. From 1 September 2024, there will be a slight change. If you choose to receive your resignation benefit as a cash benefit, you'll be limited to accessing only your vested pot and savings pot as an immediate cash benefit. If you choose to transfer to another fund, all balances from 3 pots will be transferred to that other fund. So let's isolate the cash portion, or the option where a member chooses to receive cash. So we're saying if you resign and you choose to receive your benefits as cash, you will only be paid immediately from your vested and savings pot. We'll discuss about what will happen to the retirement pot a bit later. So what you get as an immediate cash payment is your vested and savings pot. But there's now also an additional restriction. Remember when we talked about the savings pot, we said one of the restrictions is that you're allowed one withdrawal from your savings pot. This extends to resignations. So if in a tax year, you've already taken a savings withdrawal benefit, and then you resign within that same tax year, you will not get paid from your savings pot at the date of resignation. You only get paid that savings pot from 1 March of the next year. And the only way you'll get paid from your savings pot within that tax year, if you've already taken a withdrawal, is if the remaining savings pot balance is lower than 2,000 Rand. So that is an important point for members to understand and remember when it comes to resignations. The other point is when you opt for the cash benefit, what you get paid from your vested pot will be taxed according to your withdrawal tax tables, and what you get paid from your savings pot will be taxed according to your marginal rates as before. As we discussed previously. And if you choose to transfer to a new retirement fund, all 3 pots will have to be transferred, and that will be a non-taxable transfer. So we've spoken about what happens on the vested pot and the savings pot. Let's now talk about your retirement pot. What happens to your retirement pot when you resign and you choose to receive your cash benefit? If you choose to receive the cash benefit, your retirement pot will be kept as a service credit and converted to a deferred pension. This deferred pension will be paid to you only when you reach your retirement age, whether it's 60 or 65, or at whatever point you stop working and retire. You then start receiving a pension from the GEPF, and this pension will be payable for the rest of your life and will continue to a surviving spouse and so on. This deferred pension will be increased with pension increases, first of all, during the period of deferment and once you start receiving the pension payments. So what is the immediate thing that members think of? Like, oh, this thing is introducing so many restrictions. So does this mean I should resign now so that I access all my benefits now? And the answer is no, there's no need for that. So we've had members who have come forward to us and saying that, okay, I'm afraid that with everything you've told me that I will not be able to access my benefits once 2-pot has been introduced. So it's better for me to resign now. And we're saying that is not necessary. So let's look at an example to try explain that. Let's consider Mr. X, and I hope there's no Mr. X on this platform, who's age 40, has 10 years of service, and has a final salary of 300,000 on 31 August 2024. So what are Mr. X's benefit currently? It's 610,791. We've just calculated his actuarial interest on 31 August 2024. Now, let's say Mr. X decides to resign on 31 August 2027. Let's just look at his benefits 3 years later. So Mr. X will be 43. Let's assume that his salary has increased. It's now 360,000 on August 2027. Let's recall his balance on 31 August 2024. It was 610,791. And had he resigned on 31 August 2024, he was going to be paid that 610,791. It was going to be taxed at what? Your withdrawal tax tables, the ones that we looked at earlier. Now let's look at what it would mean now 3 years later. So we have assumed that he resigned on 31 August 2024. So he no longer had vested service when he started. It's now 3 years later. We're assuming that he has not withdrawn from the savings pot. So when he resigns 3 years later, he now has 1 year of service in the savings pot and 2 years of service in the retirement pot. He's got a balance of 74,000 in the savings pot and 148,000 in the retirement pot. So that his total benefit, if we just add the two, is around 222,000. But what is he entitled to if he resigns on 31 August 2027 and decides to take the cash benefit? So immediately the fund will pay him 74,266 and it will be taxed at his marginal rate. The balance in the retirement pot will be paid as a deferred pension when he eventually retires. But let's now look at that same member, but let's assume that he actually didn't resign on 31 August 2024. So he's still 43. He's getting the same salary, the 360,000. But let's look at his benefit entitlement. He's got the vested service of 10 years, because we're saying he didn't resign. But his balance is what? 742,000, because it's being calculated at a higher salary. It's no longer the 610,000 that we calculated previously. So he's got a vested pot entitlement of 742,000. He's got a savings pot, is that 74,000 as before, and the retirement pot is 148,000 as before. So his total benefit has increased, it's 965,000. That's the total benefit entitlement. So if he came forward on 31 August 2027 to resign, he would be entitled to a cash benefit of 742,657 from the vested pot. And this would be taxed according to what? The withdrawal tax tables. So same treatment as if he had resigned on 31 August 2024. Here he's getting a lower balance, 610,791. It's being taxed at the withdrawal tax tables. Here he's getting same benefit, but it's higher because it's based on a higher salary. It's still being taxed on the tax tables. He's going to get paid from the savings pot Same as in the other example. It's getting paid the same amount. It is being taxed on the same basis, which is the marginal rate. And the retirement pot, it does not have access to it still. And it's going to be retained as a deferred pension in the fund. So what this is showing is that whether you resign before 31 August 2024 or after 31 August 2024, what you have in the vested pot, you're always going to get. And whether you resign on before 31 August 2024 or after 31 August 2024, you are never going to be able to access the retirement pot. So there's no need to resign before 31 August 2024 simply because you fear two-pot. You have access to the benefits in your vested pot, which is the benefits you will have end up until 31 August 2024. You'll have access to the savings pot, which will be the same access you would have had whether you resigned before and after 31 August 2024. You will not be able to access your retirement pot, which is the same position you would be in whether you resigned before or after 31 August 2024. So it doesn't make sense to retire before 31 August, to resign before 31 August 2024, simply because you are afraid of two-pot system. Rather resign because you found a new job. So what is the tax treatment on resignation? We spoke about this earlier. Your vested pot will be taxed according to your withdrawal tax tables, which was that table with the sliding scale from 27,500 going up to 16%, and then your savings pot will be taxed at your marginal rates. So if we looked at an example of someone with 15 years of vested service and who had 1 million as a benefit, they would pay approximately 199,000 tax for the payout from the vested pot. And whatever he withdraws from the savings pot, that will be added to his income, to his normal income, to his normal salary, and taxed on that basis. And let's say he took 20,000, and if he fell on the 30% bracket, it means he would pay tax of 6,000. So in total, he would have received the resignation benefit of 1,020,000, and will have paid a total tax of 205,000. And this just, if he had opted to transfer the benefits to another fund, that would not have been taxed. So this just shows the why we always encourage our members to rather preserve their benefits than take it out as cash. Now let's look at an example of a retirement benefit. So when you retire, traditionally for the GEPF, we've said that if you have less than 10 years of pensionable service, you're entitled to if you have more than 10 years of pensionable service, 10 or more years of pensionable service, the benefit that you get is a gratuity and a lump sum. And then a gratuity and a pension. And for those who have less than 10 years, they get a gratuity lump sum being the actuarial interest. Now this will change slightly once two-pot is introduced. Because remember, two-pot is introducing the compulsory preservation of the retirement pot. And in addition to that, it's introducing compulsory annuitization of the retirement pot. Or in other words, it's forcing you to purchase a pension that will be paid regularly from that retirement pot. Unless, of course, it's below the 165,000. So you could be in a position where a member retires with less than 10 years of pensionable service, but they will not get the full amount as a lump sum, because now what they'll get as a lump sum is the vested pot and the savings pot. The retirement pot, they'll only get it as a lump sum if the balance is less than 165,000. And then let's look at the vested pot. We say the vested pot is based on the current rules. So it means whatever service you have in the vested pot, when you reach your retirement age or when you retire, it will pay you a lump sum and a pension as before. And then going forward, we're saying from your savings pot, that savings pot is only going to pay you a lump sum. And then your retirement pot is only going to pay you a pension. So let's look at an example. Let's say there's someone with 25 years of vested service, and we're ignoring seeding in this example just to simplify it. And let's assume they retire on 1 September 2029, so 5 years later. And we're working with someone who will retire with a final salary of 300,000. So at retirement, this person has 30 years of pensionable service within the GEPF, of which it's split accordingly as shown below, where it's 25 years of vested service, 3 years and 4 months of retirement service, and 1 year and 8 months of savings service. So let's look at what they'll get as a gratuity. And one thing that I maybe need to lead with, let's look at what gets paid as from the vested pot. So from the vested pot, sorry, let me start again. Let's look at what will be paid as a gratuity. So this member will get a gratuity from the vested pot and a gratuity from the savings pot. When we look at the vested pot, remember we said that it's going to be calculated based on the same rules as we have currently. So your rules say your gratuity is 6.72% of your service times your salary. In this case, your service will be a vested service, and then we calculate a gratuity of that 504,000. And then if we look at the gratuity from the savings pot, there'll be a slight adjustment needed. So it will no longer be sufficient for it to just be the 6.72%. Because essentially what we're doing is we're saying that from your savings service, if we were under the same rules as we have currently, that savings service will give you a gratuity and a pension. But we are saying, according to the Act, your savings pot is only giving you a lump sum. So we have to convert that portion of the pension that would have come from the savings service into a lump sum. And the way we take account of that is by multiplying by a factor of 3. So when we calculate the gratuity from your savings pot, it will be 3 times your 6.72% times your savings service times your salary. And then you'd get 100,800 from that vested pot. So in total, this person, when they retire, they're getting a total gratuity of 604,800, of which part of it is coming from the vested pot and another part from the savings pot. Let's look at what they get as a pension. So those get a pension from the vested pot and a pension from the retirement pot. The pension from the vested pot, it's 1/55 times your vested service times your salary as defined in the rules. Then the pension from the retirement pot, similarly, we said under normal rules, your retirement service would give you a pension and a gratuity. But now the Act is saying your retirement pot should only give you a pension. So we would need a factor to convert the gratuity portion in the retirement pot to a pension, and that factor is 1.5. So to calculate your pension from your retirement pot, it will be 1.5 times your 1/55 times the number of years of retirement service times your savings, times your salary, plus the complementary pension of 360. So you'd get a pension of 27,632 from your retirement pot and a pension of 136,363 from your vested pot. And then when you add them together, it means what you get as a pension from in your account when you retire will be that 163,996. So you might be curious, let's say two-pot was not introduced, what benefit would this member have received? So if we calculated the benefits based on the 30 years of total service, would get the same gratuity and same pension. So what this highlights is that if you do not make any savings withdrawal benefits, so if you do not reduce any of your savings service, you will get the same benefits as if two-pot was not introduced. Now, how are you going to be taxed at retirement? Your retirement tax tables apply. So your first 550,000 from your lump sum or gratuity will be tax-free. And then after that, the sliding scale will apply. And then your pension is taxed as additional income and will be taxed according to your income tax tables that we looked at earlier. But there are certain rebates for those who are above 65. So bear with me, we're getting closer to the end. Early retirements will be the same as normal retirements or every other retirement. You'll be paid a gratuity and a lump sum as before, but all based now on those 3 service periods. The only difference is that on early retirement, your early retirement penalty applies. On divorce, the GEPF can only carry out a court order. So if we've received a court order which specifies to the fund what should be paid to the spouse, that would then be withdrawn from each pot and handed over to your ex-spouse. So for example, if your ex-spouse is entitled to 50% of your retirement benefits, of all your pension benefits, this would mean that 50% of your vested pot, savings pot, and retirement pot will be transferred to, or would be paid out as cash to your ex-spouse. And then, like we said earlier, death benefits will be calculated as before and distributed according to your nomination list. And on death, the balances in your retirement pot are payable to your beneficiaries as lump sums. And if your spouse qualified for a spouse's pension, that will also be paid from your retirement pot. And then, as a summary, if we look at that table, what is that table showing us? It's saying that on resignation, retrenchments, and dismissals, you get immediate access to your vested pot and savings pot. But your retirement pot will be limited in terms of access and will only be payable at the end when you retire. Your savings withdrawals, you can only get them from your savings pot, but subject to that minimum balance of 2,000. On divorce, your ex-spouse can access all three pots. You can transfer all three pots, but the transfers are pot specific. So you have to transfer a vested pot to another vested pot, savings pot to another savings pot, and so on. You cannot transfer from a retirement pot into a savings pot of another fund. And then on retirement, your vested pot pays you a gratuity and pension. You're entitled to a savings pot, but it pays you just the gratuity. You're entitled to your retirement pot, but it pays you a pension unless it's lower than the minimum amount of 165,000. And then we've said that in terms of benefits, your vested pot is based on pensionable service up until 31 August 2024. Your savings pot is based on pensionable service, or 1/3 of pensionable service from 1 September 2024, whilst allowing for seeding capital. And your retirement pot is based on 2/3 of pensionable service from 1 September 2024 going forward. Your vested pot can be accessed on all modes of exit and it can be accessed in full. Your savings pot, accessible on all forms of exit in full. And in addition, you can access it partially as a savings withdrawal benefit, but subject to a minimum balance of 2,000. Your retirement pot has limited accessibility and it must be preserved until retirement and will only be payable to you earlier if you get divorced or if you pass on. In terms of taxation, your vested pot is taxed according to the current regime. So if you exit from resignations and so on, that is taxed according to your withdrawal tax tables. And if you retire, it's taxed according to your retirement tax tables. Your savings pot is taxed according to your marginal rates, except on retirement. And your retirement pot is taxed at your retirement tax tables. And as before, we've said that your vested pot pays you a gratuity and a lump sum, and a pension at retirement. Your savings pot pays you a gratuity at retirement, which is that lump sum, and your retirement pot pays you a pension benefit, but subject to that restriction of the 165,000. So bear with me. I know we're slightly over time, but we're close to the end. We've discussed the benefits and the changes. Let's now look at the claims process. And I think this is the other aspect that members are nervous and anxious about. So the two-pot system is presenting a headache for us administration-wise. It's the first time that you're able to access your benefits without leaving the fund. So we anticipate very high volumes because a lot of members are interested in accessing these benefits. So to make it practical for the administrator to handle the volumes that would come, we are saying that the only way to put a claim, or the preferable way to put a claim, is through digital means. So you'll be able to put forward a claim on the self-service platform. So that means before you can put on a claim, you must be registered on the platform. You must have a valid ID or passport number. You must give us your up-to-date details relating to your email address and cell phone number, because that is where some of the confirmation details will be sent to. We'll activate profile verification against your Home Affairs system, and this will take place every time a member logs in on the platform. And once a member's death has been registered, your profile will be automatically deactivated. So what is going to happen is that on the self-service platform, you'll be able, there'll be a new section where you can put in a claim. And on that section, it will first show you the available balance in the different pots, to show you what is in the different pots. And then you'll be able to click a button to submit a claim and to put in a specific amount that you want to claim. Obviously, if your balance is lower than 2,000, it will not allow you to put forward the claim, and the system will inform you. If you put in an amount that is higher than what is available as your maximum balance, again, that system will come in and tell you that the request cannot go ahead. If you've already made a withdrawal and you want to make a second withdrawal within that tax year, the system will alert you that that is not possible and will not allow you to go forward. And then once you've submitted the claim, you'll be expected to put in whatever documentation that or whatever information that is required. It will send a request to the administrators. They'll then do the verification checks and so on. And then on the platform itself, you'll be able to see the rules that apply to the different pots, particularly your savings pot, and you'll be able to see the amount and the possible tax rates that apply. But remember that SARS, we as a fund do not have access to your full income. So the ultimate tax that will be applied is determined directly by SARS and will depend on your, or will be provided in the tax directive that SARS gives us. We initially, so for the first year, because we are anticipating a lot of teething issues, we are working with a 60-day turnaround time. So we're treating it as any other benefit. But where you have clean data and where everything is immediately available, we will be able to pay you quicker than within the 60-day time frame. But we're just treating it as any other benefit. So within our SLA, payments are due within the 60 days. And importantly, and this is something that we need to highlight, is once a member has elected to take a savings withdrawal benefit, the fund has to apply for a tax directive. And once this directive has been applied for and granted, it cannot be cancelled. So as a member, you need to understand the tax consequences of a savings withdrawal and be aware that the choice you make cannot be reversed. So if you put in a claim for service withdrawal benefit, and if we get a tax directive and then it shows that you owe SARS tax and that SARS is going to withdraw from it, you cannot then change your mind and say, oh, I no longer want to have this withdrawal. That will not be reversible. So that summarizes the claim process. I'd just like to finish off with just some other things that members have to know. So the Pension Laws Amendment Bill and all the enabling legislation has now been signed into law. The GEP rules are being updated and are being taken forward to the fund to the board for approval, and this will be communicated in August. There will be a requirement to change the benefit structure to allow for the different pots. And more importantly, to allow for that 1/3, 2/3 split between your savings pot and retirement pot. But that communication will be coming through your respective employee organizations. And there'll be further updates on the claims process once it goes live, and we'll be sending out. I understand that there's some communication that's already gone out, but there'll be further communication that will be going out to guide you on the claims process. I'd like to just finish off with a bit of guidance. So we want our members to always have the long-term view. Your retirement savings are meant to give you a comfortable retirement. So it is crucial to keep yourself invested throughout your entire retirement journey. Treat your savings pot as an emergency fund. Don't see it as an extra bank account. Use it for genuine emergencies, use it to reduce debt, or use it to invest in projects that can generate you a better return than what the fund gives you. And more importantly, it's better to preserve your savings and be invested over a longer time. And also understand the tax implications of making a savings withdrawal. Know what your tax threshold limits are. Know which amount will put you in the next bracket, because you could find yourself in a position where you end up owing SARS in the end. So treat this, don't be ignorant in your journey. Be very vigilant with your savings and understand the implications of the savings withdrawal benefits that you make. With that, I conclude my presentation and we can open up the floor to questions. So I can't see the Q&A,
Yeah.
so I would have to stop sharing to be able
Brian?
to see some of the questions. Yeah.
Yeah, I think you've been talking for a long time. Thank you very much for the presentation. It's quite a lot to take in. Yeah, I think maybe leave the slide up. Let me help you. Let me read out the questions. I can read them out one by one, and then you can respond. So I've tried to filter them that the questions are not repetitive. So let me just do that, and I'll scroll. I'll start at the bottom from the earliest questions and move up. And let's see how we go. There are quite a lot of questions. I have tried to respond via text on some of the questions, and I hope those colleagues are satisfied with the responses. But let me just scroll down to the bottom to get to the first questions.
Okay, thank you.
So I think let's just do it one by one, and then you respond that way.
Okay.
Yeah. It's a lot. I'm still scrolling down. Okay. All right. I'm at the bottom. This is from Mabel Pizzo. What is the basis of the savings withdrawal maximum set at 30,000, despite the fact that from our vested pot, people could access more?
Okay, so I don't know at what stage Mabel joined the presentation. I think I tried to highlight that the maximum that can be taken out as a savings withdrawal is what you have available in your savings pot. I'm just trying to scroll to the particular example. To the particular slide. So the 30,000 limit, that is only applicable on what can be transferred from day one, from your vested pot to your savings pot. That's the 30,000. That's the only time it applies. Going forward, you can access, going forward, what you can access from your savings pot is from 2,000 Rand up until the maximum balance that you have in the savings pot. You are not restricted to withdrawing up to 30,000 in your savings pot each time.
But I think it's
sorry, Sonke, I think you're not muted.
Oh, sorry, my apologies.
So what I've just highlighted is that from your savings pot, you can withdraw anything from 2,000 up until the maximum balance. If your maximum balance is higher than 30,000, you can access more than that 30,000. If it is below 30,000, you can only access up until that amount. And I think we had given an example of the projection of, let's say, a random member. So if we look at this example, let's say this person wanted to withdraw on 30 September. They have a balance that's higher than 30,000. So they could withdraw that full 31,000. If they came in December, they've got 36,000. They could withdraw that full 36,000. If they came in February, they could withdraw that full 40,921. So the 30,000 limit does not apply to your savings pot going forward. It is just a limit on what can be transferred from your savings pot to your retirement pot. From your vested pot to your savings pot. The rationale that was used by the policymakers was that they wanted to ensure that you're not starting off at a 0 point in your savings pot. So they decided that they're going to limit what is going to be transferred up to 30,000 because they actually want you to keep what is in your vested pot available. And remember, you still have access to your full vested pot at any point that you actually leave the fund. I think we can move to the next question.
And I think, Brian, I think just to follow up for Mabel in terms of how I understood, I think thanks for giving that context. But I think what Mabel was trying to understand is that why 30,000 and why members were not allowed, for example, to transfer from the vested pot the full 10%. So why was it then limited to just 30 that could be transferred? I think you've partly answered it, but if you can just close it off in that sense.
So I cannot speak on behalf of the policymakers, but I think the intention is, first of all, despite giving you this access, the intention is to preserve your retirement benefits. So they're allowing you to have access to this, but they want you to build what you can access going forward. Your vested pot itself, like I said, you still have access to it, but only at points of exit. And it is sort of the policymakers' way of limiting your how do I put it, of controlling your behavior. Because sometimes the challenge is that some people were going to use this money simply because it's accessible and not necessarily use it for productive things. So I think to manage that, they say the rationale from the policymakers was that they want you to build up a benefit going forward. And then whatever you build up going forward, that's what you'll be able to access without any restrictions. What you had previously, they're going to give you a reasonable starting point.
Thank you, Brian. Here's another question, I think, which is a quick one. It says, this is from HQ Partner. Can I withdraw from GEPF to another registered fund? And what is the procedure?
So if I understand clearly, what they mean is, when they withdraw, when they leave the GEPF, can they transfer their benefits to another fund? Yes. When you leave the GEPF, let's say if you resign, you have the option of transferring your benefits to another pension fund or to another retirement fund arrangement. The procedure is you'd need to indicate on your resignation form what option you're choosing, whether it's the cash option or the transfer option. In this case, it will be the transfer option. But now understand the restrictions. When you transfer, the transfers are pot specific. So when you transfer your benefits from the GEPF, your vested pot will be transferred and you have a vested pot in that new fund. Your savings pot will be transferred into a savings pot of that new fund. Your retirement pot will be transferred into a retirement pot of that other fund.
Thank you, Brian. Just a quick one, just to clarify for colleagues, when Brian refers to the policy maker, just to be clear, the department that is responsible for laws and regulations of the pension industry is the Ministry of Finance. So when Brian says that he can't speak for the policymakers, he means the Ministry of Finance. So these laws, the final law as it stands, was not crafted by the GEPF, but comes from the Ministry of Finance. So just to clarify that point. Next question is from Mtembu. How many service years that 30,000 rands equate to? This is a very common question, Brian. I think if you can maybe try and explain that.
So it depends on what you have as a balance. So there's no one answer for everyone. So if you have 300,000 in your vested pot, and if you had 10 years of okay, let me go to this example. Let me try to remember what this person's balance was. So in short, it depends for everyone. So if you have 30,000, let's say in your savings pot, and you had 1 year, if you withdraw that full 30,000, that 30,000 equates to 1 year. But for someone with a higher benefit, it could only be a month, or it could be a certain number of days. So it depends on your existing benefit. So let's say someone who had a very big vested pot, and 30,000 is a small proportion of that vested pot, then that could equate to months, or even more, to maybe even half a month, or even a few days worth of service. Whereas if, let's say, someone had 50,000 and they were able to take out 30,000, that 30,000 would be a higher proportion. So if that 50,000 was based on 2 months worth of benefits, that 30,000 could be a month's worth, or a month and a half worth of benefit. So there's no one answer for everyone. It depends on your existing benefit. It depends on your particular age, and on your salary at that point in time.
Thank you, Brian. The next question, I think I can even respond to it. Is from Shirley Swanepoel. I'd like to know, if you resign on 31 August 2024, will you be able to withdraw all your lump sum? So Shirley, if you resign before the implementation of the new system on 1 September, the current rules will apply. So if you resign on that date, and that's your resignation date, you will be paid out your entire pension as per the current rules. Is that correct, Brian?
Yes, that's correct. So specifically, if you resign on 1 September 2024, let's look at what will have happened on 1 September 2024. You have a vested pot, and you'll have a savings pot, assuming that you have seeded. So you'll be paid from your vested pot and your savings pot.
Thanks, Brian. Next question is from Jacqueline. What will be in order to access the savings pot, and how long will it take before it is paid out?
So we said you have to be registered on the self-service platform. So first of all, you need to have a savings pot balance that is higher than 2,000. And you need to be registered on the self-service app. I'm just trying to scroll to those last slides. So if you're registered on the app, and if all the checks work out, all the verifications work out, and if you have a savings pot balance of at least 2,000 Rand, then you can request for a savings pot withdrawal. We've said that we're treating it as any other benefits. It should be payable within 60 days. But where we've got a clean data set, where everything checks out, and where you don't owe SARS, where we don't have any issues with bank details, we'll be able to pay you earlier. So let's look at instances where your request might fail. So we've said that if you have less than 2,000 Rand, the request won't go through. But let's say you've got more than 2,000 Rand and you put forward a request. And then when we do a bank verification, it doesn't tie up, or it doesn't work out. You'll then be notified through the app that there's an inconsistency here. Please go fix this, or please confirm your bank details. That will lead to a delay. Or we apply for a SARS directive, and then SARS comes back and says, this person, there's an issue with the directive. We can't issue a directive because whatever, a return has not been filed. We cannot proceed and make a payment, and then the app will inform you that you need to go and fix this issue before you can come forward for a payment. So where there are no issues, we're aiming to pay within a matter of weeks, possibly 3 weeks or so. But what we're communicating is that you have to give us up until 60 days. But where everything checks out and we've done all our reconciliations, we'll be paying out within 60 days. And it's part of the reason why we've enabled this self-service platform, or this functionality on the self-service platform, is to ensure that we get the request quickly, and we are bypassing the employer stage, but we still have to do some recons on especially on the salaries, and that'll be used to determine the benefits and so on. So official communication within 60 days, but where everything checks out, where we have your clean data set, and where all your verifications are done and approved, we'll be able to pay you within a shorter period.
Thanks, Brian. Next question also from Jacqueline. I think this is important to clear up because there are members who are confused about this. The question is, if a member wants to pay the money back, what are the options to do so?
So remember, you're not borrowing from the fund, or you're not taking whatever you're accessing. This is a benefit that is due to you. So how you pay it back is through purchasing additional service. But if we go back to my slide on purchase of service, we say that going forward, your whatever service you purchase. So let's say you come forward to the fund and you ask for a quotation, and you say, I actually want to purchase an additional 1 year of service. That 1 year of service will be split between the savings pot and the retirement pot. So 1/3 will have to go to the savings pot and 2/3 to the retirement pot. If you come forward and you say, I want to purchase 3 years of service, 1 year will go to the savings pot, 2 years will go to the retirement pot. So you'll be able to augment or increase your benefits through a purchase of service, but that will be split between your savings pot and retirement pot in the 1/3, 2/3 split. So you cannot come and say, I only want to purchase for the savings pot. The law is not allowing for that. Whatever you purchase as additional service will have to be split 1/3, 2/3 between the two pots.
Thanks, Brian. The next question was linked to the application process, which I think you've covered. I think what you can try and respond to here, if you have an answer, is what is the date for applying for this savings pot? That's from Sesineke.
You mean the date in which you can first apply?
Correct.
So you'll be able to apply from the 1st of September. So remember, once the 1st of September 2024 comes in, two-pot system is now effective. So you'll be able to put in a request from the 1st of September.
Then another question from Shelley Swanepoel. I want to get clarity when I want early retirement on the ages of 55 years and give my notice on 1 October 2024 till December 2024. Will I receive my lump sum and monthly pension with medical aid subsidy? She just needs clarity on that. I don't know if you got that, Brian. Yeah.
Yes. So if we recall one of the earlier slides when we were discussing retirement, there was one after that about early retirement where we said on early retirement, it will be treated the same as retirement, with the only exception being there's an early retirement penalty payable. So if you have put in a notice for early retirement, when you retire on 31 December 2024, you'll be entitled to a gratuity lump sum. Part of that gratuity is coming from your vested pot, and the other part is coming from your savings pot. But the corresponding deductions will be applied. Penalties for retiring early will be applied. You'll also be entitled to a pension. Part of that pension will be coming from the vested pot, and part of it will be from the retirement pot. And that pension will be payable to you for the rest of your life, continuing to a surviving spouse and so on. Whether you qualify for the medical aid benefit, remember that is actually not a GEPF benefit, but that's a condition of service. So if you have met the conditions of service, that means the employer would pay you that medical aid subsidy. But once again, I just want to highlight that is not a pension fund benefit, so it's not a GPF benefit, and it's not affected by two-pot.
Thank you, Brian. The next set of questions are from Lindelani, and I think I can respond to them. If I change a job and join another department or company after the 1st of September, question 1, am I allowed to cash in the pension accumulated until the 31st of August? 100%, Lindelani, you can access your vested pot. That's what it will be called after 1 September. You can cash it in. Question 2, if I choose not to withdraw the 30,000 this year, will I be able to withdraw the whole 60K next year? Yes, you'll be able to withdraw whatever amount will be within your savings pot in the following year, whether it's a 60K or any other amount.
And just to add to that, because again, there's a suggestion that he might not have fully understand where the 30K is coming from. So the 30K is a once-off transfer 1 September 2024 from your vested pot to your savings pot. If your benefits go, and then your benefits, if you don't withdraw from your savings pot, your benefits in your savings pot will continue to grow. But it does not necessarily mean that within a year they'll grow by another 30K. Depending on your salary and service and the point at which we're looking at, it could grow by more than 30K. So I just wanted to highlight that.
Thanks, Brian. Very important point. Then another question from an anonymous user. Who qualifies to withdraw money? And let's say it's those that have 10 years working service. Does it include contract jobs?
Remember, once two-pot has been implemented. So first of all, two-pot applies only to active members. So pensioners do not qualify for two-pot. So pensioners cannot make a withdrawal because they do not have any of these pots that we spoke about. Anyone who's an active member and is contributing to the fund, whether you're a contract worker or classified differently, you're going to have a savings pot and a retirement pot. And as long as your savings pot has a balance of at least 2,000 Rand, you can qualify to make the withdrawal. The other restrictions are if you have already made a withdrawal within a tax year, you cannot make a second withdrawal within that tax year. So you might be eligible for a withdrawal, but it's limited to one withdrawal within a tax year.
Thank you, Brian. Another question from anonymous user. Just to re-emphasize the point, I think, Brian, I think you did cover it. Please advise if this money will be taxed, as all monies are. Are we taxed on the level of our salaries, if at all, or how is it with this new system? I think one question also, maybe Brian, I can add there was the one is that in terms of the taxation, is the amount that you withdraw from your savings tax essentially added to what your salary is, and that's kind of considered your income, and that's what you are then taxed value on, say, your salary plus your amount that you've withdrawn.
Okay, yeah. So let's because I think there are two aspects to that question. So let's look at tax treatment. Let's look at your vested pot before we go to your savings pot. So whatever you take out from your vested pot when you resign or exit the fund, that will be taxed according to your withdrawal tax tables. And if you retire, what you get paid from your vested pot will be taxed according to your retirement tax tables. Now, moving on to the savings pot. Whenever you make a savings withdrawal benefit, and actually any other payment from the savings pot, except on retirement, that will be taxed at your income tax rates. So it will be taxed as if it's additional income to your salary and taxed at your income tax rates. Only at retirement will it be taxed on a different basis, being your retirement tax tables. So if we're to use an extreme example, let's say someone earns, let's say their usual salary is 210,000. So they're on the 18% bracket. And then I think the bracket for 26% starts at 237,000, somewhere there. So it means if this person withdraws anything higher than 27,000, it will push them into the next tax bracket. But then obviously it depends on when they make this withdrawal. So let's say they make this withdrawal before their annual earnings are close to the 227,000, to the 237,000. It means they'll be taxed still at that 18%. Then what will happen is at the end of the tax year, SARS will do a reassessment and say, oh, actually we taxed you throughout at 18%, but there's this income which we're actually supposed to tax you at 25%. And then they will recalculate, and then you will owe SARS a few hundreds or thousands, depending on how far off you are.
Thank you, Brian. Then this is a question from Siposhiko. The GEPF member statement reflect an estimated benefits. Will GEPF calculate the actual benefit stroke use estimated benefits as at 31 August 2024 to determine the 10% that must be transferred to the savings pot?
Okay, so maybe to manage expectations, and I think this has been said by the industry as well. So remember, on 1 September 2024, no fund will have all sets of information from its members or from its employers. So even though your withdrawals is effective on 1 September 2024, what we can provide you on 1 September 2024 is based on, let's say, an estimate that is subject to revision. Because for some, remember, one Sunday itself is a weekend. 1 September is a weekend. And some of the employers provide you with the salary confirmations to use a few days after the beginning of the month. So on 1 September, what you'll have is an estimate, which is subject to revision. And probably only by 7 September can we give you the definitive value. But that will not stop you from being able to put forward a request in terms of what you want to access. What we'll show you is the indicative amounts, and then the actual amounts will only be processed a bit later, maybe a week or so later. And again, this is not a position unique to the GPF. It's going to be industry-wide, where on 1 September, you will not have all the information reconciled. You can only do a reconciliation retrospectively.
I think just as a follow-up to this question, I think the next question from anonymous user is linked to that. The one question is that the transfer basically from the seed capital, is it accounted for by reducing our years of service? Which I would think is a no, but yeah, please. Did you get the question? Yeah.
Yeah. So we spoke of 3 service periods. We said you've got a vested service, a saving service, and your retirement service. And then we said the sum of all 3 will be your total pensionable service. So when you seed, you're taking away from your vested pot. That is going to reduce your vested service. So let's say you had 10 years of vested service, and the seeding results in you having 9 years and 11 months of vested service. That 1 month that you have lost from your vested service is now added to your saving service. So you still have your full 10 years of service after seeding, but it's now allocated differently. You only lose service totally when you take money out from the fund. So when you actually make a savings withdrawal benefit, that's when you lose service from your savings pot, and it will reduce your total pensionable service. Seeding itself is just a reallocation of the service components, but you have the same total pensionable service as you would have had before seeding.
Thanks, Brian. I think that's clear. I think that, again, there's questions from Edward Gumede and Colin Lovu. And essentially, the question is, just paraphrasing, can I transfer my seed capital or the funds in my savings pot back into my vested pot?
No, good question. So let's talk about what can be transferable. You cannot transfer any amount from your savings pot to your vested pot. That will not be possible. You cannot transfer any amount from your retirement pot to your savings pot. That will not be possible. But when you reach retirement, you can actually transfer your savings pot into your retirement pot. So if you decide that I actually don't want to receive this lump sum, or I don't want this bigger lump sum, you can transfer that into your retirement pot, and it will increase your pension.
Thanks, Brian. Yeah, another, I think I thought was a nice question from anonymous user. Are you able to use your savings pot as collateral? Can you borrow against the savings pot?
So I'm assuming you're asking as collateral to the fund. So with the fund, we don't offer any loan facility. So there's nothing you'd be borrowing from the fund from. But if you're speaking of, let's say, getting a loan from a bank, I don't think the bank would restrict it to only your savings pot. they'll look at your total retirement savings. So that'll be the sum of your vested savings and your retirement pot as collateral.
Okay, and then I think just a general question here, which I think is worth providing input on, is from Michael Cindy. Why is the two-pot system compulsory for everyone?
That can only be strictly answered by the policymakers, but part of the reason why it is made compulsory is that if you do not make a savings withdrawal benefit, then you'll be in the same position as if two-pot was not introduced. So if you don't want to cash in on your savings pot, you're going to retire or you're going to leave the fund with exactly the same benefits as if two-pot had not been introduced. Then the second reason why it's compulsory is because as a whole, the industry or we can say people are not retiring comfortably. They're not retiring with enough savings. So the policymakers wanted to ensure that there's compulsory preservation. So that is the secondary reason why it's being applied uniformly to everyone.
Thanks, Brian. I think you did touch on this question, but I think maybe you can just re-emphasize. Please explain the bracket creep. Will withdrawal push me into another tax bracket? From Tabi Singh.
The simple answer is yes. So if we look at the definition of or what the Revenue Laws Amendment Act is saying, the Revenue Laws Amendment Act is amending the Income Tax Act, specifically the section on what can be counted as gross income. So what you take out from your savings pot as a savings withdrawal benefit, that is now being added to your gross income. What does this mean practically? It means it's being added to your salary, your taxable salary. So yes, it is possible that you can withdraw and that amount pushes you into the next tax bracket. So what I was speaking about when I spoke about the thresholds, I was saying that you should be actively aware as a member of what your tax brackets are so that you fully understand how much would put you into the next tax bracket, so that if you choose to withdraw any amount higher than that, you understand fully the tax implications.
Thanks, Brian. And then this question here is from Lusanda. And is it true that if you withdraw from your savings pot, you won't be able to get your lump sum when you retire? I assume this would be in a case where a person continuously withdraws from the savings pot and they have little or no savings at the time that they get to retirement.
So theoretically, yes. So let's look at two extreme examples. Let's look at a member who's part of the GEPF now. They have a vested pot, and then let's say you resign at some point before you retire, and then you rejoin service. So when you resign, you'll have been paid your vested pot and your savings pot in full. Now, when you rejoin the service, you're starting from scratch. You're building up your savings pot and retirement pot, although there'll be a retirement pot from your previous resignation. Now, if every year you empty out your savings pot at your date at which you retire, let's say you're expected to retire in December. So let's say every December of each year you empty your savings pot. By the point you reach your retirement age, you will have no savings pot. So you will have no gratuity. We have assumed that in this example that you have resigned before, so you no longer have a vested pot. So you will not be getting a gratuity from there as well. So in such an extreme case, yes, you can retire and only receive a pension.
Thank you.
Sorry, let me add to that. It doesn't even have to be that extreme. Let's say the month before you retire, you decide to cash in on your full savings pot. You could get to a position where you reach your retirement age with a very low savings pot. So that's another scenario. So it is true, but it depends on such extremes.
It's fine. And then maybe just to give one kind of clarity on the issue of service reduction. Why do I lose a year from withdrawing my own money? Please elaborate further. So, I mean, firstly, it's not a year, but maybe just a moment to just explain service reduction and why we need to reduce service with withdrawals.
Yeah, thank you for that. And yes, it's not automatic that it is a year. So remember, we say that whatever benefits that is being allocated or reflected as a balance in your savings pot or any pot is worked out from your years of service times the salary at that point times the actuarial factor. So it's a direct proportional argument where if you take out something, we can change your salary, we can change your age. So what has to reduce? It has to be a service. So it's direct math, it's a direct formula. So if you had 100,000 based on 10 years, and then you take out 10,000, if you cannot change the salary, if you cannot change the actuarial factor, or which is dependent on your age, what then needs to reduce is your service. So yes, it is your money, and you're taking it out in the same way in which when you take out a balance from your bank account, the balance reduces. So in this case, your balance reduces, and your service, which determines that balance, has to reduce to reflect that reduced amount. So you're not being robbed. No one is taking away any benefit from you. It's just a direct consequence of you taking out your money.
That's fine. Yeah, I'm just looking at time. We're 5 minutes over the allocated time. Maybe let's just go through a couple of more questions, maybe for 5 more minutes, and then we can end there. Then, yeah, we haven't touched on this. What is the process if someone gets divorced after 1 September? Perhaps just touch on the implications of divorce, just for clarity.
So currently, your ex-spouse is entitled to payments from all three pots, subject to the fund receiving the divorce settlement order from the courts. So if the divorce settlement order says you have to split 50% of your pension assets, then that means 50% from all three pots will be payable to your ex-spouse. And your ex-spouse can opt to receive all three as cash or have them transferred to their pension fund arrangement.
Thanks, Brian. When a member resigns, does a member have a choice to move his or her retirement pot to a preservation fund of their choice, or is the money locked in the GEPF's retirement pot?
So maybe we need to clarify that question further. So when you resign, you've got two options, which will be there on the form. Are you transferring your benefits, or are you choosing the cash option? If you're transferring your benefits, you're transferring all three pots to another pension fund or preservation fund and so on. If you choose the cash option, you are getting your vested pot and savings pot as cash, and you're retaining the retirement pot within the GEPF. So in other words, if you choose the cash option, your retirement pot is being kept in the fund. It's not being transferred. You cannot transfer that to another fund.
Right. I think a question that's linked to this. So it's a situation where I've resigned and I don't transfer my retirement pot to another fund. And I'm not at retirement age and I leave it in the GEPF. Since I'm not contributing member of the GEPF anymore, does the balance in my retirement pot stay stagnant until I reach 60, or does it accrue interest? This was from anonymous user.
Okay, so it won't stay stagnant, but it's not accruing interest, but it's growing differently. So we say that if you resign and you choose the cash option, your retirement pot is going to be converted into a deferred pension. So whatever service you have in the retirement pot will be converted into a deferred pension. Now, the deferred pension will grow with pension increases each year. And at each point, what will reflect as a balance is the expected value of all these future pension payments you get. So we're doing a calculation each month, So your balance will always increase because the amount, the factor that is used to capitalize or increase or express all these payments as one lump sum increases with each month. So just to correct the context, it is not growing with interest, but it is growing. And it will grow with two aspects. It will grow with the actuarial factor, it will grow with the pension increase that is granted.
Thanks, Brian. And then the one question here, which I think is a new question, which we can respond to. Please clarify when you say if one has less than 10 years pensionable service and the retirement pot has 165,000, what will happen to that amount since one cannot withdraw?
Okay, so if you have, so now we're speaking at what happens at retirement or at end of or at expiry of a contract. So one of the restrictions of the retirement pot is that the retirement pot is supposed to pay you a pension that is payable for the rest of your life. So you're not supposed to receive the retirement pot as a lump sum. So if the balance in your retirement pot at the point at which you retire, and let's work with someone who doesn't have a vested pot. So if the balance in your retirement pot is less than 165,000, it means you can receive that retirement pot balance as a lump sum. If you have a vested pot, it means the gratuity that you're getting, sorry, the difference between your vested pot balance and what is paid as a gratuity. So that's what we're calling the annuity portion. If that annuity portion of your vested pot plus your retirement pot is less than 165,000, then it means you can receive the retirement pot as a cash lump sum. Otherwise, if it is greater than 165,000, it means the retirement pot is going to be converted into a pension, which will be payable for the rest of your life. In other words, you're not receiving a lump sum from that retirement pot.
Brian, thanks very much. Thanks for responding to the questions. I think there are more questions, but we have run out of time. Just to say that to colleagues that we do have another 3 sessions of webinars, and we will review some of the questions that have not been responded to and try and respond to them in the next webinars. But in terms of time, we do have to end it here. Colleagues, the presentation, the recording, once Microsoft Teams has saved it, we will download it and it will be uploaded on our YouTube channel for everyone to access and to share with other colleagues. We will post about that on social media platforms and you can access the link on our YouTube page. But colleagues, thank you very much for your time. We hope that the session was worthwhile and valuable. And there will be more sessions that will follow. If you just follow our social media channels, you will see the dates for the other sessions. And I'd just really like to thank everyone for taking the time to listen to the webinar, and also to thank Brian for taking us through the session. Okay. We are going to end the meeting now. Thanks, Brian.
Thank you. Cheers.
Yes.